everyone. I am Dr. Shweta Matreja, radiologist from Mumbai, admin of WealthCon India, and your host for today. It gives me immense pleasure in welcoming you all to our second TMP live session on fundamental analysis, portfolio building, ETFs, and mind management. I am sure you all have been bombarded with lots of assignments and study material. So, here's hoping that most of you have completed your assignments and are up to date. Just a few announcements before we start. Our session timing will be 9 to 1 like last time. We will have a break of 5 minutes at 10 o'clock, 11 o'clock and 12 o'clock. I request you all to plug in your chargers and stay connected with us throughout the webinar. And in case you have any technical difficulties, you have Natasha and my number. You can contact us at any point. Without wasting any time, I would like to invite our strong pillar of WealthCon, the very beautiful Dr. Mamta Kane ma'am, all the way from Australia. Over to you, ma'am.
Good morning, all, and welcome to another Sunday morning with Dr. Ram. Shweta ma'am has already updated you a bit about today's agenda. I'll just add on to that. So, in last session, we learned about structure of financial markets, various players, and debt products. Today is the day of one of the most important asset class in financial markets for traders and investors, that is equity and stocks or stocks. So they say to know your stocks, know the company behind it. There are at least 5,000 stocks listed on the Indian stock market. How do you pick up handful of them for your tracking and for portfolio? That's the skill we are going to learn today to assess profitability, efficiency, growth, and safety of the company in next 4 hours from none other than Dr. Ram. So let's begin. Over to you, Ram sir.
Thank you very much, madam. So welcome everyone again. How is the Josh? Have you finished all assignment in the last 10 days? Write in the chat box. At the beginning, we started with very basic level, fundamental level of economics and government security, SGBs, and we are going in detail as we progress in the course. So here is the, as we know that the thank you slide is at the end, but at WealthCon it is at the beginning because that is the main part we tend to forget. And thank you to your patience, family, and you all joining on Sunday morning. This is a great honor to us to have you on board. There are just few disclaimers which we discussed last time as well, but still reminder needs to be sent every time. Metaphors and examples are used only for the illustration purpose. It is not intended to demean anyone. So don't take it personal. While the discussion is practical oriented, it is nothing related to the academic exam. So from accountant point of view, there might be different things, but from investor point of view, we see from the investor point of view. Again, these few disclaimers, which is crucially important or necessary, because human minds, especially adult, is designed to become a judgmental and tend to forget the child mindset where we tend to learn it. Here, BSWAN is the very powerful philosophy where you take whatever it is suitable to you and discard whatever is not suitable to you, instead of becoming a judge. If you joined as a student, there is a lot to learn, and I can assure with 100% guarantee that there is something which is new for you in a TMP. So, however, if you become a judge and expert, then you will be from with the empty or you can say full glass, and you may not learn. So, I request that you keep some glass empty so that you learn, definitely learn something. Third is a donut, so you can say philosophy, where it is possible that you tend to miss jungle for a small tree. So even if I could cover hundreds of things, you may see that these things I missed it. If I missed it, there must be some reason, because if I take everything which is minute detail, then beginners get overwhelmed, and then they tend to lose the interest in subject. So I take only necessary part in all subjects. So focus on what is there to learn, not what is not there. Today's agenda is very simple, and it is a focused agenda. We'll focus on the equity segment now. As of now, we'll keep the SGB as the government security behind, and we'll go to the next segment of investment, that is equity segment, that is share market related financial instrument. In today's 4 hours, we are going to learn how to do company analysis, why we do it, and how to assess fundamentals of each company. As such, it is not difficult because when we use the goods and services for the spending, we do not have the research. For example, if you want to buy the car, we need at least 15 days or 1 or 2 months to doing the research for the buying products. So it is possible that we can do research on the companies which makes those products. Next topic we are going to discuss about index. What are the different types of indices and exchange traded funds? Third, we are going to discuss how to build the portfolio for long term. And fourth is mind management. In the first session, we did not include because it was new subject. It was new first session, but from today we are going to discuss. And after the session, you will understand why it is important in the stock market or financial course. The goal of the TMP. Now, every one of you have some goal while you register for TMP. Write down in the chat box what was your objective or intention to register TMP. 10 seconds. Because if your why is not clear, then you may lose the direction. Why should be very clear at the beginning of doing anything. So most of the scholars are writing learning is the first objective. Second, they want financial independence. Third, they want to become self-reliant in making financial decisions. And fourth, some people are writing to make the money. Obviously, that is the final agenda, but that is the byproduct of knowledge and efforts you put. The way you have the objective or goals, we also have the objective and goals. So let's say there are 100 students, 100% scholars. Our objective is that at least 100% scholars should learn how to do passive investment. Passive investment in the exchange traded funds, stocks, government security, sovereign gold bond, and mutual funds. That is our target that 100% scholars will do. Next is at least 90% scholars will do the swing trading, that is a medium term trading in the stocks. Next is asset covered call. When we start a derivative, we will have a separate discussion on asset covered call. And at the beginning, you do asset covered call in the index, and after 1 year of experience, you can start asset covered call in the stocks as well. At least 70% of the scholars should be able to do the derivative trading in the index initially, in dollar, currency, gold, and stocks. After 1 year. Now you may ask why 70%? Because derivative needs little more knowledge and experience. So it may not be possible that everyone will go into that, but at least you will know that because knowledge is never wasted. That knowledge can be extrapolated to the passive investment as well. So this is our objective or targets which we are going to achieve in next 3 months. These are the assumptions at the TMP. Fundamental assumptions we should always be aware of what are the assumption of any strategies or any technique. At TMP, we assume that every scholar has a long-term mindset and you will put the money which you don't need for next 7 years. Write down in their notes. Whatever money you are putting into demat account and trading, you should keep for at least 7 years. Now, I'm not saying that you will keep in one asset or one financial instrument. You will keep rotating the capital, but you will keep into demat account or investment portfolio. In other words, you do not invest money which you require in the short term for tax payment, grocery bills, or school fees or anything else. Because if you invest in stock market corrects or goes down 15-20%, then you will face the consequences. So point number one, whichever money you are putting should be deployed with the mindset that I will hold for 7 years. That is long-term mindset. Second assumption that how much we can earn by learning TMP strategies. Okay. If someone has come with the expectation of doubling of the money in 6 months, here they will have to get disappointed because we do not believe in a doubling money in 6 months or 1 year, even 2 years. Multi-bagger, etc. These are all foolishness. How much you can expect? We can expect that after doing active trading, you will beat all mutual fund managers in India. I repeat, after doing active trading, you will beat all mutual fund managers in India, and they take 80,000 crore for fund management. It means you will be able to beat at least 5% more than the index. It is called as alpha. Write down what is alpha. Alpha is the excess return of that of index. There is something called as beta as well, but we'll discuss beta at as and when it comes. Alpha is the excess return as compared to index. If you expect average return of Nifty around 12% or even Sensex, some people got the 16 or 18%. So you will expect return between 20 to 24% by doing active trading per year. Anything beyond 24 is little risky, and we don't recommend risky trades. So this is fundamental assumption that we will not expect any return more than 24%. It does not mean that in TMP you will get the 24% return. It means that you will develop a strategy with minimal risk, which will give you 24%. Sometimes you may get less return, and some scholars may get more return as well. We always speak in terms of average. It is not individual. So you might find some old TMP graduate, they say I made 30-40%. They are also true. There might be some graduate, they say my return is just 3-4%. That is also true because it is depend upon the efforts you put. If we ask doctors, everyone is MBBS, MD or DM. Is everyone getting the same income? Obviously no. Some people are getting 2 lakhs per month, while some people are getting 20 lakhs per month. But few might getting 2 crores per month. So do not consider that just because you registered VP and you got the keys to Alibaba Caves and Khulja Sims. It is up to you to put the efforts. How do we get income from the stock market? Remember, RCB, Royal Challengers of Bangalore, that is rent, interest, dividend, capital gain, business profit. By investing in stock, you get income from the dividend, you get the income from the capital gain, and income from the business profit. Can we get regular income from the stock market? Answer is stock market return is a seasonal income. The way medical practice is, you get more patients in July, August, less patients in the May. Similarly, farmers have the seasonal income. All businesses have the seasonal income. That means regular income is not possible from any business. Forget about stock market. So this fixed income mentality of salaried person does not hold true for any business. So answer is you will not get regular monthly income. But if you take the average yearly, you certainly get a good amount of income and return. What not to do is the most important thing in any business, and especially in stock market. At TMP or Wealthcon, we don't do tips trading. That means buying stocks based on the tips from the other people, TV pundits or Telegram channels. Even I suggest that do not take from the Wealthcon channel as well. Do not follow me. Do not follow any senior guy. You develop your own strategy. You develop your own method, and I can say you do your own research and just follow the principles. Intraday, absolutely, stop loss trading is not discussed at the TMP, since we are not doing what is stop loss trading, what is intraday trading. So we will not waste our time to understand. We will not invest into penny stocks. Penny stocks, write down. Penny stocks are the stocks which are very small size company. Usually their price is less than 20 rupees. And many of these companies are not functional as well. They have zero sales. I'll show how what is stock penny companies. I'll share and I shown you a screener in one of the videos. Let's say if I run the screen, how many companies, and if I write more than at least 1 rupee sale, there are 4,000 227 company listed on the NSE as of. If I write this way, so this is like 1 rupees sales, that is sale. You can see at least 300 company are not doing business. Their sales is zero. You can see this sales, not functioning company. And you see the current prices. This is CMP, current market price. I'll just zoom it. Sales is zero. So these are the penny companies. And you will wonder if I place here, you see that even these companies, people might boast that, see, they have double money in the best for 3 months, 2 months. You can see this. This is price chart. So, but we don't do such things at TMP because this, if you invest here, it have become zero. So this was the penny stocks. We don't do such investment. We don't do IPO trading. It is IPO trading, that is buying IPO and selling on the day of listing. We don't do it. If unless you know the IPO which you want to hold for 7 years, then we can do the IPO buy. We don't do news-based trading or any satta gambling. So here we discussed that TMP is the business of selling financial instruments. There are three types of market. First market is the market where actual goods and services are sold. We go to the market or online market as well, and we actually take the goods and services. This is the business market where company sell the products. Products means goods, services, information, whichever it is, and customer or consumer buy it and they make a profit. This is one market, business market. Now, based on this, now since company make the profit and that profit propel the stock prices, so equity market. So this is National Stock Exchange. At National Stock Exchange, we buy and sell the shares. How do price goes up? Because profit of company goes up and automatically profit is reflected into the share. So the equity market is depend upon real business market, profitability of company. There is a third type of market which we'll discuss in a subsequent live session. That is derivative market. Write down, derivative are the financial instrument whose price is derived from underlying stock price. Underlying asset, as of now, you write the underlying asset. That asset can be shares, asset can be index, asset can be gold, asset can be. So derivative is the financial instrument whose price is derived from the underlying asset. In case of shares, it is the equity. Equity market is of equity, that is shares. Write down. Shares is the financial instrument whose price is depend upon profitability of company, which is depend upon the actual business. So you understand these three markets are related to each other. So if profitability goes down, share price is reduced and automatically derivative price will go down. So these are interlinked. Where do we find the derivative market? If you search NSE India, you get the equity here. This is the information of the shares, and immediately next to the equity there is a derivative. Let's go to the stock market. So where, as I mentioned, we are mainly in a practical application. The way we have in the medicine theory class, and we have clinical posting where we see the actual patients. So this is the actual market. I suggest that you go to this NSE India website, search, do the surfing, find out what are the things are there. Let's say Reliance Industry. Today market is closed. This data is of Saturday. So this is the equity segment, that all related information to shares. I'll describe this as of now. What are the information here? So that we'll have some practical things in the mind when we discuss the theory. When we click on some shares, you can click any shares, Tata Motor, Colgate, Lux Industries, Page Industries, MRF Tire, Apollo Tires, and also. This is equity segment. If you click on this second part, that is derivative segment. Derivative is the financial instrument whose prices depend upon the underlying asset, in bracket now shares. So this is the information of the Reliance future and option. Detailed discussion will come later on. We have separate session on derivative, and in fact derivative is the one of the you can say attraction of the TMP. Today we'll focus on there is another column called as stock lending and borrowing, but this mechanism is not developed for the retailers where we can give our shares for lending. But maybe in future, if it develops, we will get another income source from the shares, that is giving shares for the renter, and you get small amount 0.3 0.1% return per month from the shares. But this is not developed for the retailers as of now. But future we might be able to do it. Today's discussion is about equity market. So this is the equity market. This first window where you see is the last traded price. Write down last traded price. The arrow will show whether price has gone up from the previous day's close. If it is going down, it will be red arrow. This price is the amount of price, how much money it has increased in previous day's close. For example, Thursday close. So this previous close is the Thursday close price. Write down close price is the average price of last 30 minutes. Market hours is 9:15, 15 to 3:30. So last 30 minutes, 3 p.m. to 3:30 p.m. The average price is calculated by the stock exchange and given as a reference value of the close price. This price is used by the mutual funds to adjust the NAVs and all the things. Fourth number here is the how much percentage it has gone from yesterday's close. Now you can see this is 0.59 percentage. This is a close price. So this is the latest price. You can see that it is increased by 17.05 rupees. This data is Friday. Okay, Monday to Friday is the working day for the stock exchange. Saturday, Sunday they take holiday. So this was the open price of the Friday. Highest price on Friday was this. Then lowest price. Then this is the close price of the Friday. This is the last traded price, single price. Close price is the average price. Then there is VWAP, forget as of now, not required for the TMP people. Okay. This order book will be live when market is live. Now it is closed, so it is not there. Then there is a trade information. Okay, we will discuss this table in a detail in a assignment video. All information of the trade is posted, mentioned. And this is the live data when we check the live market. Then there is a price information, and there is information related to the value at risk that we will discuss. This table we will discuss in detail later. As of now, I am just giving a brief introduction of equity market. Here it is equity segment. Okay, symbol is the Reliance. IC number is the International Security Identification. This is a unique number. Status is listed. Date of listing is 1995. Now you may ask, Dhirubhai has started in 1978. But why? Because NSE started in this. So this is the first day of Reliance on NSE. So here you find the industry. So write down where to find the industry of this company on the NSE India website. It is mentioned. P as of now forget, or write down the Reliance P is 40, 24. This is the face value. This data is necessary for our fundamental analysis. Where do we find the face value? It is available at many places, but easiest is to find the NSE India. This is the face value. This is the number of shares. Can anyone write how many shares are? You write in the crores. Find out the share capital. Share capital is very simple. It is just a multiplication of face value with issued capital. Now you see the Reliance has 676 crores shares. 676 crores. Yesterday I told you to find out the MRF share capital. You could have written the MRF. You will get the how many shares are there and share capital. Now share capital will not fluctuate every day because face value is stagnant and number of shares also more or less fixed. So share capital will not fluctuate every day. But you may say some variation in the annual report is something different, stock exchange is different, screener is, because it is a time lag. Maybe annual report is 1 year ago or 6 months ago, you are saying the latest. So this is the latest. If you want to find the latest share capital, this is the place to find the latest share capital. And then there is information of derivative segment. And there is another information which is not point of discussion today. I showed you equity segment. Where to look for the equity segment on NSE. Derivative will take when we discuss the derivative. Now the most important question, why do we analyze companies? Why not just get the list from the Wilcon seniors, which stocks we can buy, MPT days, MD spot value, or why don't I post a simple list of 30, 40 stocks and we can buy? Why? Why we are doing all this? What we are doing? It will take me only 2 minutes to post the list of the shares. 2 minutes. And everything ends. Then why are we doing it? The reason is you should be self-reliant. Okay, you should not be dependent on anyone. You should not be dependent upon WealthCon. You should not depend upon me. You should not depend upon. It should be self-reliant. That is number one. Next thing, when you do your own analysis, you have the confidence in the company. You develop the faith that I have checked the balance sheet and company is good. So even if some stock pundit comes on the TV and says some his opinion, you say no, that is his opinion. My opinion is that based on my fundamental analysis, company is good fundamentally. I'm not bothered about all rumors. Stock market is full of lies, manipulation, rumors. You might wonder, I think 2 years ago, some scholars sent me a news that Mukesh Ambani has died in UK, and news will come after 1 week. So I had a huge position in derivative position in Reliance. So I got scared. So I bought the put position for protection, and I also posted a message in the TMP Alpha groups. Kindly take the protection for the Reliance. And after 3 4 days, Mukesh Bhai appeared on the screen, TV. I said, this is a wrong rumor. But this is how rumors are spread by the manipulators. So beware of that. What I am trying to tell that when you do self-analysis, you have the confidence. I'll give another example. Suppose if I conduct course or not I, your MD medicine, whoever is MD medicine, he start a course of 12th science students. Come here. In 3 days, I will teach you 20 symptoms: cough, pain in abdomen, fever, headache, backache, 20 different symptoms. I'll give 20 drugs, 1, 2, 3, 4. As soon as patient come, you just prescribe the symptomatic drug. I'm sure it is possible to train this boys of 12th science in just 3 days and they can start practice. Do you agree with me? They can start practice and they can treat patient 50% patient they can treat with just 3 days knowledge. It is possible. But what happens if some patient check out, if some complicated case, then they will be in trouble. This is happening with the stock market investing as well, trading. People attend 3 days course and from Monday they start trading. It is not the way. You spend decades in medical college, you develop the faith, confidence, you learn everything small things about it. And that's the reason you can do medical practice. Similarly, for investment as well, you cannot do based on the tips. So it is like 3 day MD medicine course and start treating the patient. It's not possible. It takes little time. When we do the stock market analysis, we make a decision. There are only two types of decision: buy or not, sell or not. That's it. For investor, decision is very simple. So when you do the analysis of company, you have to make decision whether it is buy or not. And sometimes it's clear cut buy, sometimes it is clear cut no buy. There might be a borderline, and as a rule at WealthCon, if doubt, then discard. It means if there is clear cut indication of buy, then buy. If doubt, discard. If no, it fix. Because we need hardly 2 dozen companies, 20 to 24 companies. And there are 4,000 plus companies which are listed. And we can get enough of good companies. So why to waste our time to run behind the company which you are not sure? Another reason that you should not invest into doubtful company, because that doubt remains in your mind. When your price goes, you are doubtful. You should be very confident that my analysis is perfect and I will stick to it. So we are discussing fundamental analysis, right? What is the fundamental analysis? Fundamental analysis is the analysis of the business, profitability of the company, future growth, and its valuation. This is the fundamental analysis. Full stop. Fundamental analyst try to find out the companies which are at cheaper than its actual values. And based on that, they can predict the future price movement. Valuation we'll discuss later. But what is fundamental analysis? Is this fundamental analysis the analysis of business profitability of the companies and its valuation. These are the three ways of doing fundamental analysis. One is called as top-down model and other is called as bottom-up model. What is a top-down? You start with the index. How much is the latest Indian GDP? Write down the chart. Guess करो, guess करो. Correct number जरूरी है. Suppose if you find out the companies, listed companies, as I mentioned, at least 1 lakh or 10, and if you download this data, export data, and find out how much they are selling in a year, you may notice that at least 50% of the GDP of India is produced by these listed companies. It means if you want to invest, if you do the calculation of this entire, you will find out how much exactly sold by the companies. This is homework for you. I will not waste the time. My point was discussion is that Indian GDP is the gross domestic product. It is the product by organized sector and unorganized sector. So majority, more than 50 to 60%, is produced by the organized sector. What is organized sector? Organized sectors are the companies or LLP registered with the or any startup registered with the Ministry of Corporate Affairs. That means LLP, private limited company, listed companies, because that data is available in the government. Unorganized sector is the proprietary firm, partnership firm, or vendors, though they have, even if they don't have the bank accounts. So unorganized sector. We are investing in a stock market which is organized sector. So go to the index, that is Nifty 100 or Nifty 50. Then go to the sector. Then there are various sectors in the index itself. So if you see the economy, there are multiple sectors. Can you write down the sectors in the chat box? Whatever you know, sectors means the industry. Start from A, B, C, D. A for auto, B for bank, C for consumer good, D for drugs, pharma company, E for entertainment, F for finance companies or NBFCs, B for banks हो गए, G for any goods, capital goods, H हो गया तो health हो गया, I is IT companies, T is transport company, and so on. These are the various sectors. Why it is necessary to learn the sectors? Because sectors have the cycles. So in a market, if you go to the market and if you check the daily prices of onion or this price, sometime tomato, onion, sometime price is high, sometime, am I right? In the commodity market, it means their profitability will be also fluctuating. If profitability fluctuating, that means their share price will be also fluctuating. So sector wise, some sectors even in economic depression, some sectors are going down. If you remember in COVID, most of the businesses were shut down, but the healthcare and laboratory business went down. So understanding different sectors is useful for following reasons. Reason number one, you can diversify your portfolio into different sectors so that your portfolio will not fluctuate because of if you invest in just a single sector. Suppose if you invest only in the banks or auto, and if that sector, entire sector goes down, then your portfolio. So understanding of sectors is necessary for the diversification. Number one. Second is if you go to get little expertise, then you can increase your more weightage on that sector. When we discuss the portfolio, that time I'll discuss what is weightage and how you can change your sectoral weightage to get the more return. So understanding of sector. How are you going to learn about sectors? When you read the annual report, at least one company from the each sector, there is a management and discussion analysis, and in that section, information of sector and industry is mentioned. So stock market is not just a one-day task. This is a lifelong learning. So you read about what is happening in these sectors. We are going in for the top-down. National GDP, then organized sector. Unorganized, we are not here to invest. Under-organized, different industry and sector. I shown you where to find the sector or company in the NS and read about that sector by you reading the annual report of it. Or you can search on Google. There are many information about sectoral information. Then under one sector, there you can find one or two companies or even there are many companies who do the MD-Spot MPTDS analysis and further analysis and select the shares. This is the top down. Okay, and this is conventional method from the books. If you search Google, this is what they will explain. Up to this only, and this is for us. So book definition of top down is this. There is another is bottom up. You start with the company and find out its sector and then go to bottom. You do both ways. Another way to find the companies is first you run the screening. Let's say I show that some screen. Suppose there are 4,000 plus companies listed. You want hardly 20 or 24. Then first step you have to do is the eliminate. So screening. How to do screener website is the fantastic website free of cost. Just log in with your Google ID. I'll run a simple screen that I want the companies which are paying at least 100 crore tax. Very simple screen. You eliminated 90% companies. You got the only 443 companies which are paying tax more than 100 crore. What is the best way to find out whether company is profitable or not is tax and dividend, because that is actual number. Rest all numbers can be manipulated in balance sheet, profit loss statement, cash flow. Everything can be manipulated except two numbers, tax and dividend. So I'm more inclined towards tax and dividend. So if you run the screen, we can say screener, you will find that you get them. Then we see there are different industry as well. In this 443, there are 49 finance companies, bank companies, pharma companies, IT. These are numbers which are in this list. So after running the screener, you get the 400 company. Then you download this data and you can sort it out by the industry. After break, I'll show how to sort it, and then do the company, find out the company. Again, use the MPTDS and MD-Spot analysis. You do the another analysis which we are going to discuss and decide buy or not. That's it. If it is buy, write down buy. If it is not, destroy. Similarly, this is here you are starting from the top. That you are starting that there are 4,000 companies. I eliminated 90% companies by simple screener. We can use another filter as well. Okay, and use another filter to find out. 100, what to write? You add dividend last year 100. It means this company has paid 100 crore tax in last year. Dividend 100 crore. It means at least profit before tax is at least, write down charge, at least. So profit before tax, yesterday there was a public question. I told you what are the ways company can distribute profit before tax. So profit before tax is the number, okay, which can be distributed into the tax. Second is dividend. Third is, I say, reinvestment or investment. Fourth was the principal payment, or if there are no lenders, you buy back, company buyback, and social service. Now someone asked me whether donation is tax free, but that is a donation, not a CSR. Okay, when you do the CSR, you pay tax and CSR as well. So this is not major component discussion, but you should be aware. And I took it just for to make the mnemonics, T dips. Otherwise, social service is not a major component because companies develop own social service and they do the something. So this is the main things which can be done from the profit before tax. And this two, tax and dividend, are the proxy to profit before tax. Investment can be manipulated. Even this number can be manipulated. This number is in public because this goes to government. This goes to public. So if I put this, what does that mean? Write in the chat box. How much PBT? At least, if any company is passing through this filter, tax 100 crores, dividend 100 crores. What is the meaning of this? It has minimum 200. Minimum, because that is how it has passed or given to outside. That means it should be 200, 300, 400, 500 or more. Definitely. So minimum is PBT is 200. And if you run this query, you get 250 companies. And now this is, and if you see the industries, you get almost companies from the all industries. Okay. So let's say farm. So if you click it, these are the pharma companies you want to find it list. And if you now this is very easy to do the MPTDS and further analysis of this small company. So what we did is we eliminated the useless companies and focus on this. And now this becomes very easy. From this 20 company you want to find out two companies. What we are discussing is how to approach top down and the screening sector companies. I'll show from the index how to approach from the index. So these are the practical things which you are supposed to do in next week. These are the projects for you for GTech. Go to the NSC India website, click on the indices, write down the steps. You have to karna hai. You will have to do in GTech project. Next week you will have to do this. So you see here, I'll just zoom in so that you can see that. Numbers are small, and if you are watching on mobile, then it will be difficult. And again, if you have the eye vision problem, then it will be again okay. So these are the indices. You read here, broad market indices. Broad market indices are based on the market capitalization. What is market capitalization? Market capitalization we are discussing here. Market capitalization word is capitalization. Now in a finance, single word can be used for multiple reason. In even normal English, we use single word for multiple reason. For example, sir. Sir is used as a teacher as well as boss or as well as the feudal lords in Europe. Similarly, capitalization word used to decide the market value. Market capitalization is nothing but the market value. Interest capitalization means spreading interest to multiple years with the another meaning of capitalization. If we use the word capital in English, there are several meanings of capital. For example, capital market, capital of city, capital punishment. If you remember some more, you write it down. So market capitalization word has two meaning. One is capitalization means market value. Interest capitalization is the spreading of the interest to multiple years. So here market capitalization is face value, not face value, share price multiplied by number of shares. This is market capitalization. Market capitalization is the product of current market price, share price multiplied by number of shares. If you want to buy any company and 100% shares, the amount which required is market capitalization. So NSC can organize these companies as per market capitalization and find out what are the most top companies. Let's go to the screen now. If you run the market capitalization, let's take more than 1 crore. I'll just take more than 1 crore. And then this is the market capitalization. And if you sort data by market capitalization, now there are more than 4,000 companies, right? See this. So highest market capitalization is 19 lakh crore, Reliance. Second highest is 15 lakh crore. उतना पाकिस्तान का भी budget नहीं होता. Third is SDFC. So this data is sorted as per the market caps. Smallest will be one because that is what I mentioned. One. There may be smaller company less than 1 lakh as well. But you are understanding what I am trying to say. If you sort companies by market capitalization, by the size, then top 100 companies as per SEBI rule, Security Exchange Board of India, top 100 company will be considered as a large cap. Large cap means capitalization. 101 to 150 are called as mid cap. Mid cap. Cap is the short form for the capitalization. More than 251 are called as small cap. This is the classification of SEBI. But I believe this it has a flaw because even if small cap become a trillion company, but it cannot go because larger company will become there. So it means in India there will be always 100%, only 100 rank or 100 companies will become large. There is some flaws in that. Maybe it will change some other way. But you got the point that top 100 company by the market capitalization called as large cap. Now you might have heard this large cap word in the mutual fund. So write down large cap mutual fund is the mutual fund which invests into the large cap companies. That is top 100 companies. Mid cap mutual fund is the mutual fund which invest into the mid-cap company. Mid-cap companies are the companies ranked from 101 to 150. Ranking is done by the market cap. Here I did the ranking. Small cap mutual funds is the mutual fund invest into the small cap. That means the market capitalization rank are coming beyond 250. What is the advantage of investing in large cap, mid cap, and small cap? There are some advantage in each category. Number one, large cap companies move slowly and steady. They will not have the wide fluctuation. That means large cap company, let's say Reliance, current market price is 2,900. It will not become like 300 immediately. Small cap company can become fluctuate. It can double in 1 month or it can reduce to half in 1 month. But large cap company don't fluctuate too much. So safety is more in large cap. There is a trade-off between safety and return. If you are seeking safety, then return will be your limited. If you are seeking too much risk, return you might double money in small cap in 2 months, but it is possible that it can half as well. So that's the reason we diversify. I'm showing here how to reach from the top down. So go to the broad market indexes. So these are the NSE has done the ready-made job for us. So when we discuss indices, that time I also discuss this broad market indices. Then there are other sectoral indices. If you go down, sectoral indices and then thematic indices and so on. So I'll just finish one. Once you go to the, let's say, sectoral indices, now you want to invest in banks, two banks. So you click on this, you will get the list of the banks which are listed into the Nifty bank or it's ready-made list. Okay. So there are, I think, 12, 13 banks. You can study these banks and find out two. So this is one way. That is one way. One way is to go to the NSE, go to the sectoral indices, find two companies from each sector. You click on, you search, you do the analysis. That analysis I'm going to discuss soon, and find out two good companies. Two companies from the bank, two companies from the auto, and from to each sector. So these are the sectors. Write down the sectors. Sector indices: bank, auto, financial services, FMCG, that is fast moving consumer good, IT, information technology, media, metal, pharma, EFC bank, private bank, realty, healthcare, consumer goods, consumer durables, and oil and gas. This way you can reach that I showed here. So this is the first way, first flow chart. Index, sector, companies. Second chart I showed to go to make your own screener. The way I showed you tax 100, dividend 100, and find out. Then you sort the data by the industry and then do find out good companies from the industry. This is the second way. Third way, now when you go to the market, supermarket, or this is assignment to you, go and find out the products located in your house. After that, there is coffee, tea, biscuit, Colgate, etc. You got this, or someone told you a name of company. So what you do then, you do the MPTDS analysis immediately and find out the sectors and do the analysis. So that is, we can say, starting with the company. Let's say you got this product. You find out the name on the label, manufactured by, and do the analysis. So this is third way to analyze.